Cost of retained earnings. We are now talking about raising funds through investors. Okay, so Averse Allison is looking to grow her company, and the only way to do that is to increase her cash flows. Allison has a viable business, but is too scared to assume the risk of borrowing the money herself. So she decides her best approach is going to be to raise the money through equity. She has two options. She could sell her equity to preferred advisors under the terms that they are preferred shareholders, or she could sell her shares to common stock pigs as common stock. We're going to now talk about all three methods within the cost of retained earnings and what you're going to need to know for the BEC exam. We're also going to talk about the cost of preferred debt. Okay, so now we're talking about the cost of common equity. This cost is going to be considered the cost of common stockholders, which is generally going to be more risky than the cost of preferred stock. And why is that? Well, if the company fails, and let's say they file for bankruptcy, then guess what? The common stockholders are going to be the lowest priority when it comes to getting their money back, okay? So that means that they are going to be assuming more risk. So that being said, more risk is going to demand a higher return, and therefore the cost of common stock or cost of retained earnings is going to be higher than if it were for preferred stock. Okay, so let's talk about our methods of calculating our cost of retained earnings first, and then we can dive into our preferred stock. What we're doing here in these methods is now calculating our common stockholders' required rate of return. We got three methods for cost of retained earnings that we're going to need to know about for this exam, aka this is going to be our cost of common stock. Okay, so here we go. We're going to talk about capital asset pricing model, CAPM, okay, also known as CAPM, the discounted cash flow model, also known as DCF, or bond yield plus market premium, okay, BYRP. Alrighty, so method number one, CAPM. Okay, so name of the game here, we want a cost of retained earnings equal to the summation of our risk-free rate plus our risk premium. Okay, so our risk-free rate is going to be our hypothetical investment that has no risk at all of financial loss within a specified period of time. Okay, so this will always be a lower rate of return than any other investment because any other investment will have some degree of risk. Okay, so this can be like US Treasury bonds, right? US Treasury bonds have never defaulted. Okay, say a little prayer, they never do. So what is our market risk premium? Think of this as like purchasing an index fund. Okay, so here we are now purchasing the NASDAQ, the S&P 500. We're purchasing a fund. Okay, so because we aren't assuming what's called unsystematic risk, we're going to be assuming only the systematic risk, right? This is the risk that is only associated with our overall marketplace. We aren't buying one specific stock, we're buying an index fund, okay? So we're buying a diversified bundle of stocks, so we mitigate our risk a bit here, but we still need a risk premium because we are buying something a little bit more risky than, say, those US Treasury bonds. So we're going to be absorbing more risk. Now we got beta, okay? So now we are buying one individual stock, and our beta is going to tell us the overall risk relative to the rest of the market, okay? So this is going to reflect our volatility of this particular stock. I would write this down, beta equals volatility. So if we have a beta that equals 1, we're going to say here that this is as risky as the rest of the market. If beta is less than 1, then the company we're buying is historically less volatile, okay? So that means our rate of return needs to be lower. If beta is greater than 1, then the company we're buying is historically more volatile, okay? So what does that mean? That means our rate of return needs to be higher. Okay, so when it comes to CAPM, here's the formula we gotta know, all right? I want you to get a piece of paper out, I want you to get a pen out. I know, old school, right? I want you to write this formula down at least 6 times. If that's not enough to have it memorized, write it down another 6 times, then another. You'll impress all your friends, I promise, but more importantly, you'll know it for the test. Okay, so CAPM is calculated as follows. All right, so cost of retained earnings, that's what we're calculating, right? So that's going to equal the risk-free rate plus risk premium. Okay, so they're probably not going to give you that risk premium flat out, so you're going to need to know how to break that out. So the cost of retained earnings is now going to equal the risk-free rate plus beta times the market risk premium. Okay, so again, they're probably not going to give you that market risk premium. They might, but if they don't, we need to know how to break that out as well. So the risk-free rate plus beta times the breakout of market risk premium. Okay, so market risk premium is going to be market return less the risk-free rate. So we're using that risk-free rate again. All right, and this is just like one of those things, you know, if you need to memorize it, memorize it. So write it down 6 or 7 times and make sure that you know how to dissect the question and plug and chug into the correct equations, okay? So let's take a look at an example. XYZ Corp has beta of 1.75, while the risk-free rate is 7.5%. The company has a market rate of return of 16.5%. So we're going to calculate the cost of retained earnings while applying that CAPM. So we don't know our risk premium, right? So that's going to be broken out into beta times our market risk premium. We don't know our market risk premium, but we do know our market rate of return. Okay, so we know our risk-free rate, we know our beta, and we know our market rate of return. That's going to be enough to calculate this. So we know what? We know that our beta is 1.75. We know that our risk-free rate is 7.5%. Okay, we also know that market rate of return is 16.5%. All right, so starting with that risk-free rate, 7.5%, this is going to be added to beta times what? Beta times market return less the risk-free rate. All right, so beta of 1.75 times 16.5%, right? That's going to be our market rate of return less the risk-free rate of 7.5%. Okay, so now we could just go ahead and calculate this exact percentage. Okay, so 0.075 plus 1.75 now times 0.09, right? 0.09 is going to be the difference between 16.5 and 7.5%. So we're going to be multiplying those two. That's going to give us 15.75%, and that's going to be added to the 7.5%. All right, so our final answer here, 23.25%. So just know this formula, guys. Know this formula cold, and you're going to be able to dissect this question and plug it into the right components of the formula. That's one formula down. We got two to go. We got to know our DCF, our discounted cash flow model. Okay, so this is going to be calculating the value of our investment based on future cash flows. So this can be due to past growth rate forecasts. Okay, so things like that. Okay, so this is going to be calculated by using the following formula. We're going to take our cost of retained earnings, which is going to equal the dividend, but here it is, it's going to be dividend subscript. Okay, so in English, that means that not today's dividend we're using, but the dividend 1 year from now, or however many years from now. It's our future dividend. So off chance they provide you with a question that has been given today's dividend, that means what? That means we have to go back and calculate the future dividend. Okay, so that is the dividend today, dividend subscript 0, times 1 plus the growth rate. Okay, and that is going to be divided by P subscript 0, and that means what? That means we're dividing it by today's market rate of the outstanding stock. Okay, so P subscript 0, 0 indicates today's market rate. So this fraction is going to be added to the constant growth rate. Finally, we have the bond yield plus risk premium. Okay, so this is going to be our third and final method. And this is definitely going to be the easiest of the three methods. So this is going to be just what we say it is going to be. Okay, so this is going to be our pre-tax of long-term debt, right? Our pre-tax cost of long-term debt, plus our risk premium. Finally, they might ask us to compare all of these methods. Okay, so we have to have a comparison of the three. So we take these three and we divide it by 3. Doing a comparison can make it more accurate approach for our investors, whoever's analyzing this, right, or assessing, the calculation of the cost. So all 3 of these are going to have different results. So sometimes they're going to want you to calculate the average of the 3. Okay, so that's our cost of common stock. How about our cost of preferred stock? This is going to be less costly than the cost of common stock, but more costly than the cost of debt. Why is that? Because in terms of priority, it looks something like this. First priority is going to be creditors. Second priority is going to be preferred stockholders. And third priority is going to be common stockholders. Okay, so as preferred stockholders, we don't get our money back until the bank gets their money back. Common stockholders won't get their money back until preferred shareholders get their money back. Okay, it's the circle of life. Okay, so before we wrap this up, let's take a look at a quick example of cost of preferred stock. Blake Company is calculating its cost of preferred stock. Assuming that preferred stock is 8%, $100 par value preferred stock, and has been issued at par value. Okay, so please note the preferred stock that has been issued at par value has an issuance cost of $4 per share. All right, we're going to need to take that in mind. We're going to now be computing the cost of preferred stock. How do we do it? So we have a preferred stock dividend, which equals our dividend percentage times par value. Okay, so this is going to be the cost of preferred stock, which will equal the dividends divided by our net proceeds. Okay, so what do we know here? We know that our dividends are $8. Why do we know that they're $8? Because 8% times 100 is $8. And what are our net proceeds per share? Okay, it's going to be that $100, and we're going to have to subtract this by the issuance cost. Okay, so that carrying value gets subtracted by the issuance cost. So it's going to be 8 divided by 96. We have an 8.33%, which will represent our cost of preferred stock. That's all we got for you guys for cost of retained earnings and cost of preferred stock. Okay, so just know these formulas. All this stuff's really simple once you know the formulas. So plug and chug, memorize this stuff if you need to. Get a piece of paper and pen, write it down a bunch of times.